Hello everyone. Today we will discuss about Treasury bills. Treasury bills basically is a money market instrument that covers the short-term needs for different governments. It covers the liquidity needs for different governments. As it is mentioned in the first point, it is a short-term debt instrument that is issued by a number of governments. We will discuss in the case of UK and US especially. In the UK, the Debt Management Office makes new issues on a weekly basis on behalf of the UK government to cover its liquidity needs because it's money market instruments. It covers the short-term needs for different governments. They are typically issued with the maturity of 91 days, mean to say approximately for 3 month maturity period, and also issued for 182-day maturity, approximately covers 6 months. So in the UK, we have seen that there are two maturity periods that treasury bills are issued for 91 days, mean to say for 3 months, for 182-day maturity, mean to say for 6 months. But in case of US, if we will discuss about in the US, the Department of the Treasury also offers a weekly issue on new debt with maturity of 28 days, mean to say for 1 month, as well as 3 and 6 months like its UK counterpart. And we have seen that most of the other countries also issue similar short-term debt instruments which have the same characteristics. If we will discuss that there are the similarities in the debt management office of UK and Department of Treasury of US, that both issue treasury bills on weekly basis. UK also issues on weekly basis, and the maturity period in the UK, 91 days, mean to say for 3 months, and 182 days, approximately 6 months. And in the case of US, they also have a maturity period of 1 month and 3 months and 6 months, like its UK counterpart. Other governments also issue similar notes to fulfill their short-term needs, and that short-term debts have same characteristics almost like T-bills. And we will discuss another point regarding T-bills. They are backed by the promise of their respective governments. They are often referred to as a promissory note because the governments promise to redeem the face value amount to the investors. So that's why it's referred to as promissory note. The yield they offer provides a benchmark level of risk-free return available on other short-term money market instruments in their respective markets. Mean to say that the return offered by the treasury bills are almost similar rate of just like a risk-free return. We can say that this is a risk-free instrument. There is no risk in treasury bills. Treasury bills pay no coupons. This is very important point, that it means treasury bills pay no interest. No coupons mean no interest. It means the treasury bills are issued at discount to their nominal value, with the discount providing the return to investors. Treasury bills are simply redeemed at their par value. I mean to say that if a treasury bill has a face value 1000 and government issues it for 950, it means the face value of the T-bill is 1000 and the government is issue to investors. Initially investor will pay 950 and at the time of maturity investor will receive 1000. It means investor pay in the beginning 950 and at the end of the maturity investors will receive 1000 and the difference is 50. That is the basically return for investors. So in this way investor earn on treasury bills, and there is no coupon, no interest rate mentioned for treasury bills. This is the difference between face value and discounted value of the treasury bills. This is all about regarding treasury bills that we have discussed. Thank you. Hello everyone, we will discuss about certificate of deposit. As previously we have discussed about treasury bill, uh, T-bill. That is mostly issued by different governments, but the certificate of deposit is issued by financial institutions. Uh, in the first point, it has been mentioned that a certificate of deposit is a time deposit commonly offered to consumers by banks and other financial institutions like insurance companies and banks that restricts holders from withdrawing funds on demand. In certificate of deposit, the financial institutions restrict the holders of the funds that they cannot withdraw the money before the maturity date. But there is some relaxation as well, as it is mentioned in the second point that although it is possible to withdraw money, but this action will often incur a penalty that is linked to pre-agreed interest rate. So if any holder of the fund want to withdraw the money before the maturity date, then he or she has to pay a penalty that will be pre-agreed interest rate. Similarly, just like a T-bill, a certificate of deposit is also considered as promissory note because it's simply a promise to repay the holder of the fund by bank and other financial institutions. In the next point, the most common maturities for certificate of deposits are 3 month and 6 month, whereas we have discussed in T-bill, we have seen that in the case of US the maturity time was also for 1 month, 3 month and 6 month, but in case of UK the maturity time was 3 month and 6 month. So in the case of certificate of deposits, the maturity time is 3 month and 6 month. All right. In the next point, point number E, they are purchased at their face or par value and pay a specified interest at maturity. We have seen in the T-bill there was no coupon, there was no interest rate. Mean to say the treasury bill is issued at discount value and at the time of maturity it has been paid at face value, and the difference between the discounted value and the face value will be considered the return for the investors. So here they are purchased at their face or par value and pay a specified interest rate. So it means certificate of deposits pay specified interest rate at maturity. Therefore, at maturity or redemption, the investor receive their full face value plus the specified interest rate that is set at the time of contract, mean to say when the investor will deposit the money. In some cases, at the last point, if we will see, in some cases, certificate of deposits pay a yield slightly higher. Why? Why certificate of deposit have a slightly higher yield as compared to T-bills? Because we have learned in the finance that if you have to bear higher risk, so the return will be higher. It has been considered that in certificate of deposits the risk is slightly higher, the credit risk is slightly higher. That's why the return will be greater than T-bills. They can be issued in any denomination, in any value, in any quantity. There is no fixed value or quantity in which the certificate of deposits will be issued. So we have learned that certificate of deposits are issued by financial institutions, but the Treasury bill is issued by different governments to fulfill their short-term needs. Certificate of deposit is also a money market instrument to fulfill the short-term needs, to fulfill the liquidity needs. Thank you. Hello everyone. Now we will discuss about commercial papers. As previously we have discussed about Treasury bill, certificate of deposits, and now commercial paper. Commercial paper is also a money market instrument that is issued by large financial and non-financial institutions as a short-term borrowing facility. As we know that treasury bills are issued by different governments, certificate of deposit issued by financial institutions, but the commercial paper are issued by financial and non-financial institutions. Uh, in the second point, that the debt is unsecured because there is no security or collateral against it, but is normally backed by unused bank-based credit lines. If we will discuss about maturities normally range from 2 to 9 months and are denominated in minimums of US $500,000, and similar amounts are also in other currencies as well. So, if we discuss about the largest market, largest commercial paper market, so the US domestic CP market is the largest one, but the similar markets also exist in UK, Europe, and Japan. Uh, Next point is the interest rate paid on commercial paper depends on market conditions. It means that there is a correlation between interest rate on commercial paper and market conditions, and secondly, as well as issuing companies' credit rating. So there are two main points. The interest rate is depends on market conditions and issuing companies' credit rating. So this is all about, we have discussed about treasury bill, certificate of deposit, and commercial paper. Hopefully you understand all the concepts, and please subscribe my channel for more videos. Thank you.